please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome to NSE FinWiz Season 5, and we are here to discuss about asset allocation and portfolio diversification. And we have an eager group of working professionals here ready to ask their questions to our experts here. And of course, the experts will be fine-tuning and explaining the discussion that is about portfolio diversification and asset allocation. Let me introduce you to them. Hemant Ristagi and Firoz Aziz are here to answer any questions that our professionals here have about the concept. So let's quickly deep dive into it, and let's start with the first question, the definition of asset allocation and portfolio diversification. Hemant, if you could give us a basic primer on the concepts and the differences most importantly.
So when we talk about asset classes, there are two types of asset classes that we generally look at. We have financial assets, which is equity and debt, and on the financial asset side, you have on the physical asset side, you have real estate and gold. Why it is important to do asset allocation is because different asset classes behave differently over different time period. A second important thing is that our goals are different. In some cases, we need to look at safety of capital. In some cases, we need to look at beating inflation. So that's where, when we talk about safety of capital, debt comes into play, and then we talk about beating inflation, and then equity comes into play. Many a time we confuse asset allocation with diversification. Yes, asset allocation does allow you to diversify a portfolio, but when we talk about diversification per se, it is within the asset classes too. Now, for example, when we're talking about debt, and suppose you're investing in mutual funds, there are different funds for different time periods. There are liquid funds, there are short-term funds, there are debt funds, there are then hybrid funds, and there are equity funds. Within equity, for example, you've decided how much money should go into equity as an asset class. Within equity, again, there are different segments of market. You have large cap, you have small cap, you have mid cap. That's how you diversify your portfolio within an asset class. So that's the basic difference between asset allocation and diversification.
So what's the optimal asset allocation strategy that you would recommend to the folks here?
There are three variables. One is the external factor, which will determine the asset allocation. One is my own path. The path which you have taken is going to be known to you largely, not to an outsider. So that's the next variable. The third variable is your moving parts of life. If you have another dependent, your asset allocation might change. So now if I just keep the rest of the two important elements aside and say look at the contemporary external factor, which is common to all of us, a person should have 60 to 70% in equity, 20 to 30% or a little more in debt, 0 to real estate from an investment standpoint, 0 to gold from an investment standpoint. If there's an ornamental value to gold, and if that is what is appealing to you, then that's not investment. Right? So this is the contemporary asset allocation, only looking at the external factor. You can't superimpose this to yourself unless you see what path have you taken for yourself.
All right. And Hemant, take us through the different asset allocation strategies. You have systemic, you have constant weightage, dynamic, tactical, there's a whole universe of strategies, strategic systems which you can use for asset allocation.
One of the simple strategies is to follow a goal-based investment approach. Now, we all have short-term, medium-term, and long-term goals. In the short term, obviously, we cannot take risk because it may be like 1 or 2 years away and we require money for a specific purpose. That's where the safety of capital will be very important. So clearly, the money has to go into debt. If it's a medium-term goal, let's say 3 to 5 years, we can take some amount of risk, but still the focus is on safety of capital. So it can be a hybrid product, which is a mix of equity and debt. Now, if you talk about long-term goals like our children education or retirement planning, which could be like 15 to 25 to 30 years, that's where we need to beat inflation. And equity is an asset class which allows you to beat inflation. So the moment you follow a goal-based investment approach, whereby you define your goals, assign a time horizon, it helps you in deciding asset allocation. And you rebalance your portfolio maybe once in a year. So for a common investor, I think it makes sense to follow strategic asset allocation.
All right. And Firoz, what are some of the rookie mistakes to avoid when someone looks at their portfolio and it's time to rebalance or it's time to review their portfolio? What are some of the rookie mistakes to avoid?
The most prominent mistake is people review this more often than not at a very high frequency. Make sure that 1 year kind of frequency when you're looking at long term is a good frequency level. And importantly, rebalancing and review is the most important activity. If you have taken off as a pilot and then if you're not going to traverse this path with monitoring, it's unlikely that you will reach where you're destined to, right? Or you imagine that you would get there. So review is important, but not a very high frequency. 1 year frequency or a triggered base frequency would be the ideal.
It's been an interesting start to the discussion here on asset allocation and portfolio diversification. We focused on the former in the first segment. We'll take a short break. When we return, we'll be focusing more on diversification. Stay tuned to CNBC TV18. Welcome back. You're watching NSE FinWiz Season 5 here on CNBC TV18, where we've been discussing asset allocation and portfolio diversification. Now, focusing on the latter, let's talk about the risks of a diversified portfolio when both your stocks and bonds enter bear territory. That becomes an interesting juncture for anyone looking at their investment saying, what exactly do? I have a diversified portfolio, but guess what? Both stocks and bonds, which means my mutual fund, equity mutual funds and my debt funds are both at risk. At that stage, how should one approach their investments, Hemant?
So if you have the similar fund, 15 fund, all investing in small cap, all investing in mid cap, and when the mid cap and the small cap does not do well, suddenly you'll find the entire portfolio is not doing very well. So I think it's very, very important that when we talk about diversification, you need to have a bias towards the large cap in your portfolio. So maybe around 60% in large cap and 40% in mid cap. That again can be tricky for you to decide how do I allocate that to different segments of the market. Two ways of doing it. One is you either go into large cap and mid cap separately, and if you can't do that because monitoring can be an issue there, you go into a multi-cap fund. And the multi-cap fund will decide as to how much money will go into large cap, mid cap, and small cap. So if you diversify your portfolio in the right sense by having the right allocation, investing in the fund which have a consistently performing track record, you will see the impact of, when the markets are going down, not so much on your portfolio. Similarly, it still gives you the upside whenever the markets are doing very well.
Take us through the portfolio diversification strategies for starter or mid-career professionals who are here sitting here. What would be some of the tips you would give them?
Tip 1 is not have more than 6-7 funds. If 7 funds are not good enough, replace one of them rather than adding the 8th. Point 2, when it comes to diversification, don't try and dilute your equity mutual fund holding across asset management companies more than the top 10. Point 3 is never buy 2 schemes of the same fund house, ideally, right? Not that 2 schemes can't do well, but if you're diversifying, then you're better off getting 2 different asset management companies rather than having 2 schemes of the same fund house. If you're following these 3 steps or these 3 tips of portfolio diversification, it is unlikely that you will have optical diversification. You will actually have a diversified portfolio.
All right. Now it's time for the audience to list out some of its goals that it had in mind for achieving financial independence. And let's see what advice the experts have to give. So I'll be calling out your names and you can get up and give a short introduction and list out your goals accordingly. The first name I'll be calling out is Sunil Bhambani.
Goal that I mentioned is to own a house without home loan. And the time horizon is, I think, 10 years.
Okay, you want to own a house without a home loan. You have a time horizon of 10 years. The amount that you want to accumulate is 2 to 5 crores. On a monthly basis, you can save about 20 to 25K, which I presume you could increase over the years.
So let's say if you're talking about 2 crore here and you can invest, let's say 25,000 per month. Clearly with that money, you're not going to be accumulating that kind of corpus in the next 10 years. Okay, so I still feel that, one possibility that you have is as you move along, you can increase the amount of investment. I still have my doubts whether you'll be able to achieve the target of 2 crore in 10 years time. Because, what happens is that we invest for 15, 20 years. After 10 years, every 5 years, the money will double. But in 10 years, clearly, you will need much more investment to make. So my advice to you would be maybe relook at it again. And maybe there's no harm in looking at a loan if you feel that you need to buy a house.
All right, I hope we've answered your question. All right, the next person I'll be calling out is Arup Kar.
I can accumulate around 25 to 30,000 monthly.
Okay.
So what would be the ideal things that I can invest on?
All right, so let me recap here. You want sufficient funds for your family as well for yourself post-retirement. So retirement fund is the target that you're mentioning here.
Yeah.
And you want to accumulate around 2 to 3 crores. That's the target that you mentioned. And on a monthly basis, you can save 25 to 30,000. And your time horizon is 15 to 20 years.
First is whenever you are looking at a long-term plan, you have to make sure that there could be some party spoilers on this 20-year journey, and there will be attack from things which are outside your control. If I was you, the step 1 I would do is anything which is unforeseen needs to mitigate that risk. The cost of mitigating health insurance and making sure that the increased expenses on hospitalization and treatment are taken care of will be my first tick mark. Then I would look at what is left with me to make investments into mutual funds, which are going to be a key driver of my strategy. And then I would do the asset allocation like we discussed and choose the right fund.
I hope we've answered your question. Now, the final audience member I will be calling out for this segment is Rinaz Sheikh.
To become financially independent over a span of 15 years with an investment of 10 to 15,000 per month.
What's the corpus that you're looking at the end of, say, 15 or 20 years? What's the corpus you want to generate?
That is 2 crore.
That is 2 crore. Okay.
As your income levels will go up, you should start allocating more to this. Because, you know, it's very important to quantify every goal. You want to be financially independent, but you should first decide how much money will be required. It's very important that you consider inflation over there. Don't look at today's costs. Begin with 10,000 rupees. Don't delay the process, because starting investing early is very, very important, because that's where there are 2 important things here, that you must benefit from power of compounding. So you have to be in the right asset class, allow your money to grow. As we all know that equity tends to be volatile. So one of the ways to handle that volatility, in fact, to turn it to your advantage, is to invest systematically. Because when you commit to invest a fixed sum every month, you keep emotions out of your investment process. So which means that you're investing at different level, your average cost is going to be lower, and you truly benefit from the potential of equity as an asset class.
All right. Rinaz, I hope we have answered your question. Thank you so much for asking. On that note, we'll take a short break. When we return, the floor is open to the professionals here at Persistent Systems to ask their questions on asset allocation and portfolio diversification to our guests here. Stay tuned to CNBC TV18. Welcome back to NSE FinWiz Season 5 here on CNBC TV18. We have been discussing asset allocation and portfolio diversification. The floor is now open to the working professionals here at Persistent Systems to ask their questions to the experts. So let's have a show of hands. Who has a question for our experts here?
I have been investing all over the place, but it's not going in a very correct manner. So how do I stop spreading myself all over the place and keep things simple?
Well, I think it's never too late to correct your investment strategy or philosophy that you've been following. First thing you need to see is where all your investment is. For example, there are 2 ways we invest our money. One is the traditional methods, which is like you invest in bank deposits, you have invest in bonds or small saving schemes. So you need to really go back and look at your portfolio as to how much of your money is invested in this. For example, all of us have a lot of money going into PPF, then we have EPF or NPS. Right, and then we have bank deposits. So clearly, all these instruments, except 1 or 2, will not allow you to beat inflation in the long term. Okay, the market-linked product, which is managed by the mutual funds, the factor is that there are 2 or 3 different kind of funds. You have income fund, you have hybrid funds, and you have equity funds. And if you look at asset classes, you need to go back and see, for example, how much time you still have. For example, if you have another 10 years to go for a particular goal, okay, you can actually realign your portfolio in favor of equity there. First thing you need to do is to exit from those traditional methods clearly, okay, and start looking at market-linked product. But asset allocation still has to be very, very important. You still need to, in my mind, look at your goals going forward from here, and then do asset allocation, and then include mutual funds in your portfolio.
Thank you so much for asking a question. The gentleman in the red shirt, if you could get up.
Where is finance or mutual fund going to be 5 years from now? If you look at the way Bitcoins are going in.
Bitcoin started out to be a currency. Today, it is being spoken about as an asset. The job of a currency has to be currency. In exchange of that, you should buy products. If a currency is being used as an asset, it's the principal incorrect mechanism. Okay, not that bitcoins can't rise from here. If all of us wish to buy in the world 1 bitcoin each, where would it end? Nobody knows. It's anybody's guess. But fundamentally, in something which is incorrect, principally, will I want to make money by chance? I would want to make money by design. So please understand what are the principles of investing. If there's a apparent flouting mechanism which is completely out of sanity, I would not want to participate. Is it an opinion that bitcoins can go down? That's not the opinion, but it's not right.
Let's have some more questions.
If someone would like to take a high risk, so what portion of the portfolio to go in the thematic funds, and are there any pointers to select for the thematic funds, especially in the infrastructure part?
There is a thumb rule which says that around 10% of your portfolio can go into sector and thematic fund, but it all depends on each individual investor. It depends on at what stage of portfolio building you are, how much you understand equity as an asset class. Have you built a portfolio of equity to take advantage of other segments which are available in the market? Now, for example, if you have just started investing, you need to be comfortable with asset class called equity, okay? And you need to build a portfolio of diversified fund.
Right.
Once you've understood the risk associated with that, what to expect, what not to expect, that's the time you can look at thematic fund. Thematic funds are not bad. They are more diversified than sector fund, but they're obviously not as diversified as a normal diversified fund. The problem with the thematic fund is, there can be a couple of issues. One is that a fund manager thinks that this is a theme which will pan out very well over the next 2-3 years. The market can take more time to acknowledge that, recognize that. So it can take much more time. The second thing is, like I said, it tends to be aggressive by nature. So when the markets are doing very well, if you look at the top performing fund, you will find maybe sector and thematic fund right at the top. Yeah. So the strategy of chasing short-term or medium-term return is not something that you should be following. You need to be comfortable with the asset class. You need to build a diversified portfolio, understand what equity is all about. That's the time, if you want, like I said, you can have maybe around 10% in sector and thematic funds.
All right. I hope we have answered your question. We have time for one last question.
So my question is, let's say I'm a little, I'm not that much risk-averse, so I can take some risk. So if for a given goal, now if X amount of money is all in mutual funds, now let's say if I'm put in some stocks, let's say for long term, say 5 years, 10 years, 15 years, let's say I want to take that risk. Now, how much percentage of that money of X should put in stock?
So if you have to know a direct equity portfolio, how risky or how safe it is, it might still be a direct equity portfolio, but two different direct equity portfolios can be 3 times more riskier than the other. So if you say the word risk, then I think you're duty bound to measure it. We run a reasonably large broking outfit. We did an analysis of 2 lakh accounts to see whether they have beaten mutual funds in the long run. So the output was stark. 88% of them couldn't beat selected mutual funds, reasonably well selected mutual funds. So if you think you are going to beat this odds of being in that 13%, pursue it. If you are a newcomer and you want to do direct equity, I would strongly recommend against it, because it is not the first level. It's like first level, second level, fourth level, fifth level. If you have to go to class 10, you have to go through class 1, class 2, class 3. If you finish that, then you can probably look at 10, 15, 20%. Otherwise, I would say you're better off not going that path, because it will be a distraction and you have a job to do, right? And analyzing balance sheets is a full-time job.
All right, on that note, we'll conclude this episode of NSE FinWiz Season 5. I'd like to thank our guests for sharing their perspectives on the topic of asset allocation and portfolio diversification, and of course, the working professionals here at Persistent Systems for their very engaging Q&A with the guests. And thank you to the viewers watching at home as well. I hope you learned all the concepts that you needed to know about financial planning and wealth management. Stay tuned, more such knowledge being imparted to you on future episodes. Stay tuned to CNBC TV18.
So the event was very, very insightful. I think it, probably I got the first time introduction of the asset allocation and different classes of asset allocation, and what are different, broadly 2 categories, but in each of that category, what are the subcategories, and the way we should look at every of those investments.
I would like to revisit my investments. I would like to form a medium-term and long-term plan and set a goal. That's the first and foremost. And then depending on that, form a strategy to see how I can reach that goal in the given time frame.